Hey everyone, welcome back to the channel. The numbers are officially in. The IRS has released the new federal income tax brackets for 2026, and they're going to impact virtually every American taxpayer. While tax updates might seem technical, these are a massive deal for your money. They determine the size of your paycheck, how much you can contribute to your 401 and Key or HSA, and what you'll ultimately owe. And here's the inside scoop that many overlook. These aren't just routine, automatic changes. They are a calculated response to persistent inflation and crucial new provisions written into our tax code. That means, for millions of us, filing our taxes next year is going to feel noticeably different. Let's get into what you need to know. All right, so let's dive right into the details of what's actually changing. The main event, of course, is the official release of the new 2026 federal income tax brackets. It's crucial to remember these numbers apply to the money you earn starting January 1st, 2026. When you sit down to file your taxes in the spring of 2027, these are the brackets that will matter. The fundamental structure remains the same. We still have a 7-tier system with rates climbing from 10% to 37%. However, the income thresholds for each of those brackets have been adjusted upward to account for inflation. This is great news for taxpayers, as it means you can earn more money before being pushed into a higher tax bracket, effectively giving you an automatic tax cut. Let's break down the new numbers, starting with single filers. The 10% bracket now applies to your first $12,400 of taxable income. The 12% bracket kicks in on income over that, up to $50,400. The 22% bracket covers income from there up to $105,700. Next, the 24% bracket applies to income up to $201,775. The 32% bracket then takes you up to $256,225. From there, the 35% bracket extends all the way up to $640,600. And finally, any taxable income above $640,600 is taxed at the top rate of 37%. Now, for married couples filing jointly, where the thresholds are generally doubled, providing what's often called a marriage bonus. You'll pay 10% on your first $24,800 of joint income. The 12% rate applies to income up to $100,800. The 22% bracket extends up to $211,400. The 24% bracket goes up to $403,550. Next, the 32% bracket covers income up to $512,450. The 35% bracket takes you up to $768,700, and the 37% rate applies to any joint income above that amount. For heads of household, typically single parents supporting a family, the brackets fall between the single and married thresholds, offering a bit of tax relief. So, what does this all mean in practical terms? These adjustments create valuable financial breathing room. Let's imagine a single filer earning $95,000 in taxable income. Under the old brackets, a larger portion of their income would have been taxed at 22%. With the new, wider brackets, more of that same $95,000 stays within the lower 12% and 10% brackets. This small shift could easily translate into saving several $100s on your final tax bill without you changing a single thing about your finances. When you're dealing with rising costs for everything from gas to groceries, that's real money back in your pocket. The IRS makes these changes to combat a sneaky phenomenon known as bracket creep. This happens when inflation pushes your salary higher, but your actual purchasing power, what you can buy with that money, doesn't increase. Without these adjustments, your cost of living raise could push you into a higher tax bracket, causing you to pay more in taxes and effectively punishing you for keeping pace with inflation. These annual adjustments ensure the tax system remains fair relative to the economy. Now, this brings me to one of the biggest myths in all of personal finance. I get this question constantly. If I get a raise that pushes me into a new bracket, will I actually take home less money? The answer is a resounding no. That is not how our progressive tax system works. It's not an all-or-nothing switch. Think of your income filling up a series of buckets. The first $12,400 fills the 10% bucket. The next chunk of money fills the 12% bucket, and so on. Only the dollars that spill over into a new, higher bucket are taxed at that higher rate. All the money in the lower buckets remains taxed at the lower rates. So, a raise is always a good thing. You will never lose money by earning more money. You're just paying a slightly higher rate on that new, additional income, not on everything you earned. All right, moving on from the tax brackets, let's talk about arguably the single most important number for the vast majority of taxpayers, the standard deduction. This is the specific dollar amount that you get to subtract from your adjusted gross income, AGI, before any tax is calculated. It's a powerful tool that makes a portion of your income completely tax-free. For 2026, these numbers are also getting a healthy bump. For single filers, the standard deduction increases to $16,100. For married couples filing jointly, it rises to $32,200. For heads of household, it's going up to $24,150. This is a huge deal because roughly 90% of all households now take the standard deduction instead of itemizing. This trend started after the Tax Cuts and Jobs Act of 2017 nearly doubled the amounts, simplifying the filing process for tens of millions of people. For a married couple in the 22% tax bracket, the 2026 increase of $700 in their standard deduction means their taxable income is automatically $700 lower. That translates to an extra $154 in tax savings just for showing up. You don't have to track receipts or fill out extra forms. It's an automatic benefit. Of course, these changes directly impact the decision to itemize. To itemize, your total eligible deductions like mortgage interest, state and local taxes, SALT, up to the cap, charitable contributions, and large medical expenses must add up to more than the new, higher standard deduction. As the standard deduction continues to climb, that hurdle gets higher, meaning even fewer people will find it financially beneficial to go through the hassle of itemizing. Speaking of simplification, let's cover some of the other key adjustments for 2026 that might fly under the radar, but could be important for your situation. The Alternative Minimum Tax, AMT, exemption amount is rising. This parallel tax system, designed for high-income earners, will now affect even fewer people. The federal estate tax exclusion is jumping to $15 million per person. This means a married couple can now pass on a combined $30 million to their heirs before any federal estate tax is owed. The annual gift tax exclusion remains at $19,000. This is the amount you can give to any individual in a year without having to file a gift tax return. For those with a Health Flexible Spending Account, FSA, the maximum contribution limit is increasing to $3,400, with the carryover amount rising to $680. The maximum adoption credit for qualifying expenses rises to $17,670, providing more support for families looking to adopt. The Earned Income Tax Credit, EITC, a critical benefit for low to moderate income working families, is also getting a boost. The maximum credit for a family with 3 or more children will be $8,231. Meanwhile, some provisions are holding steady. The personal exemption remains at $0, a change that was offset by the larger standard deduction. The child tax credit is still set at $2,200 per child, and the controversial SALT cap, which limits the deduction for state and local taxes, is moving slightly higher to $10,400. So, with all this new information, what are your action steps? First, once 2026 kicks off, it's a great idea to review your paycheck withholding. Your employer's payroll system will update automatically, but using the IRS's tax withholding estimator online is a smart 5-minute checkup to ensure you're not having too much or too little tax taken out. Second, if you're a freelancer, gig worker, or small business owner, you need to adjust your estimated quarterly tax payments to reflect these new brackets. Getting ahead of this in early 2026 will prevent any surprises. Third, this is the perfect time to rethink your retirement strategy. The new brackets might change the math on whether a pre-tax 401 or a post-tax Roth IRA makes more sense for you. And while we wait for the official 2026 contribution limits, we can expect them to rise, giving you even more room for tax-advantaged savings. Finally, if you've experienced any major life changes, getting married, having a baby, buying a home, changing jobs, now is the time to see how these new tax rules will intersect with your new life situation. It's not just about one number. It's about how all the pieces of your financial puzzle fit together. Understanding the tax code isn't just about compliance, it's about strategy. And with these 2026 numbers now official, you have a valuable head start to plan for a more financially efficient year. So, now I want to hear from you. Are these 2026 adjustments a meaningful tax cut for your family, or do they barely cover the rising cost of living? Let me know your take in the comments below. I'm genuinely curious to see how these numbers affect your household budget. And if this breakdown was valuable, please hit that like button and subscribe. I release these guides to turn confusing tax law into clear strategies you can actually use. Because at the end of the day, real financial power comes from knowing exactly how to keep more of your hard-earned money. Thanks for watching, and I'll see you soon.